What's up, everyone? This episode is brought to you by Mantra Chain, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the program, but for now, Mantra, thanks for making the show possible. All right, everyone. Welcome back to another episode of On the Margin. Today, I'm joined by David Choi of MetStreet. David, welcome to the program.
Thank you for having me on.
Hey, dude, I'm really pumped about this conversation because you and I are going to spend a lot of time talking about the famous, what you've kind of dubbed the Widowmaker trade of crypto, which is the grayscale or GBTC trade that took a whole bunch of big funds down, maybe most famously Three Arrows Capital and kind of BlockFi to a certain extent, which you were in and kind of deeply know the mechanics of. But before we even get there, I thought it would be fun to start, give a little bit of background about when you got started in crypto and maybe rewind the clock back to kind of 2018 and 2019 era, because I think the opportunity set that existed for investors back then would paint it'll be helpful to understand as to why this GBTC trade was so popular. So you kind of take us back then, like, how did you first get into crypto? What were some of the stuff that you were doing back then? And maybe we can lead into what this GBTC trade was and why so many folks were excited about it.
Absolutely. I can give a little background about, I guess, where I came from too before crypto. So my first job was actually doing like art collateralization. So, fireworks, like paintings, Warhols. And then I worked at Deutsche doing Regal investment banking. So kind of been in the finance space and gone to crypto because I guess it was my natural calling. I mean, 4chaner, I guess, growing up and, the people are talking about on there. And I was like, I didn't really belong in the banking world, I guess, because I was just such an internet native. Got into crypto early. ICO, like asked me to get into ICOs, like the people that were ruining ICOs. I guess I was one of those people. And then that obviously evolved into like, more, I guess, akin to like a venture ecosystem. But, back then it was pretty DeFi, which I think a lot of people can say was like very dark times when we thought like Neo or like IBM Ledger were the futures or like supply chain stuff. It was just really off. Like Chainlink Stream was like kind of a thing where it really wasn't used for anything. It's just like, it's going to provide data for the real stuff, not really for DeFi. And so like a lot of this stuff wasn't really a real use case yet. And DeFi was kind of like the first glimmer of like hope for what crypto could be. So that's kind of, my background. And then I guess after that, I was did a lot of trades and investments as my focus. So angel investing wasn't a thing. Funds didn't really exist back then, as you see today. There weren't really institutional funds, not much LP capital. It was more so like, hey, we have some prop money and we're going to just play the game. I can give a little context to that, kind of what the era was like.
I was just going to underline, man, that's so resonated with me because that was when I first got into crypto as well, 2017. And back then it was like, it felt like there was this barbell between like DentaCoin and like strawberries on the blockchain. And it was like, both of these things just suck. Neither one of these things feel particularly exciting. And then after that blow off at the end of 2017 going to early 2018, it just felt like the tumbleweed was blowing through the metaphorical, town square of crypto as an industry. And it just felt pretty desolate. I mean, there wasn't much working back then, but what was some of the stuff that you were kind of getting up to?
I guess in 2019 it was like a seminal year because I was just like the year after the days. Like this was like the post FBG era, as we all kind of remember. Like when Binance was kind of emerging and like Tron, they were just doing the manufactured IEOs, which back then was just kind of like they were just trying to find a use case, and they were just trying to find a business to operate on. And it was working. They were building exchanges were the only businesses that actually worked. So like FTX was like probably one of the bigger like token launches that year that like actually made money. Arguably the only one because, I think it was like grid mining. People knew like it's over. Like everybody was in this trade and it didn't make money. And that's like, 2018 to 2019. So this was like the first time the market was starting to be active. This was just right when DeFi was at the cusp and it wasn't like a run yet. So really nothing was making money outside of just exchanges. There was no like organic on-chain activity. So a lot of the questions were like, where can we find arbitrage ops? Where can we find money ops? Where can we find yield, which really didn't exist back then because DeFi didn't exist. So looking for trades was just like kind of hard to find. And there was, I guess, this like ruminations of this, I've actually heard this first, but among a lot of the institutional clientele, I guess, of crypto from the DRW jump and like all these other types in the world that were kind of, softly looking at the space. And they're talking about this inefficiency with GBTC, which for some reason the premium was so high. But the original trade wasn't actually just using leverage at all. It was just like putting money BTC in, which to quickly describe it, like people would put money into this product, like BTC into the product, and they would get this share, and that share would be worth a lot more than their investment. The only risk was, theta, which is you had to hold it for a year before you can redeem it. And this obviously felt strange, but it makes sense because it was 1 year long, and to farm the ARB, it would take too long for you to redeem it, and you would take the BTC risk. So it was not that popular, even though this premium existed for like years, like 5 years, like it was a premium. And why the premium existed, I can get into it in a minute. But the main idea was like, this was a trade that existed that actually made money where nothing else did. So it's kind of like
David, if I could just also, like, for folks in the audience who obviously folks will have heard of GBTC. Now it's the ETF, which is issued by Grayscale. But for years, right, just to set the scene, GBTC was the structure of it. And you probably know better than me. It's basically like a closed-end fund, right? And this was a way where if you were exactly, and if you wanted to own Bitcoin, but you couldn't for whatever reason, whatever regulations you were whatever regulatory stuff made you not be able to actually hold the underlying spot, or if you just literally didn't want to deal with the pain of custodying underlying Bitcoin, you could own this thing. But when you're talking about the premium discount, that's like these shares would trade at a discount or premium to NAV, and for years they traded at a premium, right? So did I get all that right, or is there
precisely? So you would put you say like you put a BTC in that's worth 5K back then. That's very low back then. But then a year later, it'd be 100% premium, or it would be worth 10K in the equities market because you're trading shares on OTC markets. And for context, this is the number one traded shares on like effectively like Pink Sheet's equivalent of a market, OTC markets. It's not, this wasn't even Russell or even like NYSE or anything like that, or like NASDAQ. It was really like, it was a trust, exchange traded trust. It wasn't exchange traded fund. The close ended for the audience that doesn't understand, like it means you can't redeem it. As in like if you put a BTC in, it's stuck there. Like you get a shares that represent it, but you can't redeem it. And you can imagine if there's a premium, that means that the inefficiency will continue because you can't redeem it. And that's the big difference. If you can redeem it, it's an ETF. And historically, closed-ended funds always trade at a discount because you can't redeem it. And usually the way it's priced is like, hey, here's a management fee, and you extrapolate out 7 years, and then you discount to the present. So if it's 2% in 7 years, whatever, it could be like a 10% discount, 20% discount, 30% discount. That's actually how TradFi has priced these assets. For some reason, this was a premium. And it was a premium because, before 2020, like, how did retail buy BTC in the United States? Well, they could go on Coinbase, which is some, back then was a sketchy, like kind of like, had all these liquidations happening left and right, way back old when, because this was, Wild West, or use some like, Chinese off platform exchange, or you just try to find an OTC like provider. But most people would just buy GBTC because they're like, it's GBTC, and they don't actually, and it's like a weird pricing, like 23 cents or something, $23 or something. So they would just buy that. And that's why the premium existed, because of, bad infrastructure. That was a theory, at least. And that's why people bought it. And that's why the premium was so high, because of uneducated retail. And of course, after 2020, when everybody's back at home, everybody knew how to buy Bitcoin because, you just go on Coinbase and you're home. You're like, I can figure this out. You weren't like at a bar or like at work. You just had to buy quickly. So that was kind of like the reason why this premium existed structurally.
Yeah. And again, for folks, it's a little bit of a wacky concept. It's like consider it like a GBTC, the fund is a box, right? And if you put $100 worth of Bitcoin into this box, then what you get is shares that get minted to you. And those shares should theoretically track. There should be $100 of share for every $100 that's of Bitcoin in your box. And I think that point that you just made is a really good one, because in theory, it's like this should be worth less, right? That the share should be worth less in the box, because if I just have the actual underlying, then I can go trade it and do whatever I want with it. But now it's locked in this box. I have to pay management fees, so it should be less. But in GBTC, it was the opposite because of these weird structural factors that you're describing. So when you put your Bitcoin in the box, the shares were worth twice what the box was. So in theory, the value of the share should track the box, but they weren't. So that actually ended up representing, especially at a time when there wasn't, especially if you were a big fund, like what 3 Arrows Capital eventually ended up growing into, there weren't that many opportunities for you to deploy in size. So maybe that's kind of the setup of, we're coming out of this brutal bear market, this really long crypto winter, there wasn't a huge opportunity set. Even a lot of the opportunity sets that did exist back then were probably only available to like retail traders or whatever. Like you couldn't put a lot of these trades on in size. And so GBTC sort of set up this super interesting opportunity. So you describe like what, again, like just concretely, like what the arbitrage was that people were doing. And then what was it like? Was there a lot of demand for this in the early days? Like who kind of got in first? Like when did this trade really start taking off?
In a sense, there was a mean regression. I actually heard somebody like do this trade with some leverage as like probably one of the first people to do with leverage, just in the meanderings in Puerto Rico, which is where I lived. And he made like 16x or something on this trade. Because if you think about it, 5x leverage, the price of the asset doubled. So that's like 10x. And then the premium was like 20, 30%. And you just multiply that. Then all those together, you end up getting 15x, like dollar for dollar, which, back then was absurd to hear. And obviously that was the top of the mean regression before you get to the negative 40% as is. And that was kind of like what made me first hear about this was like this guy made a lot of money. It's kind of like how a lot of trades get shared in the hedge fund world. You talk about like, oh yeah, some guy made money. Like let's see if this trade actually still works. In summary, like the way it was first described was as I described. You just deposit the cryptocurrency inside the trust, and then trust gives you shares 1 year later. There was a big structural change that happened at this time. Obviously, they were launching different exchange-traded trusts. That wasn't just BTC denominated. I was actually doing only ETH. And it was actually, frankly, it was still like the premium has never gone to a discount ever in history. So it felt very interesting because, it just hasn't proven to be in a discount. It was starting to be shared, I noticed, we didn't get shilled this, but like other funds did, where it was just being sold as a trade. And just before I jump in here, I don't think BlockFi, I don't think Grayscale, I don't think they were malicious actors at all. I actually think they were just pretty decent business people because they just found an inefficiency in the market where for some reason the product was actually working and it was actually serving a need. All of this really was structured because there wasn't an ETF because of government inefficiency. And if the ETF existed, none of this would have happened. But because there was an inefficiency, they created business around it. And so I don't actually think these participants were actually malicious. Maybe the people that are asking money from their friends to cover up a hole were malicious, but not the institutions that were facilitating the stuff. And BlockFi was obviously interested in getting yield, because hedge funds would pay to borrow crypto, right? So let's just start from step one. You have $1 million, right? $1 million, and you buy with leverage to be delta neutral, as they say, which wasn't at all. You borrow like $3 million worth of BTC, or 5 million. The average leverage on this trade, from what I heard, was like 15 to 20x, like 5% down. Like it was, because it was big institutions, or you had a really good Twitter profile, as some people started using as a diligence metric. And you would borrow, say, $3 million worth of BTC. You put that inside the trust. So, and then the trust, whatever the premium is, say it's 100% premium, you get 6 mil worth of shares. And now if the price of the underlying asset also increases, then you also make money. So if it goes up by 2x, and now it's 12. Now, and the only problem is that, of course, it could be 12x. But what if the premium was the negative symbol in front of it? Yeah, it's negative 12x now. So this obviously caught everybody blindsided when it did go to negative, because, like I said, for the last 6 years, it's never been a negative. The real like market movement, why it suddenly became like really high, like premium to a discount, was because of something called the Form 10. At this time, the Form 10 was this process where the 1 year lockup was now 6. So as you can imagine, like the theta risk obviously exponentially increases the longer duration is, even by 3 to 9 months. But now this was now like 12 to 6. So everybody was more interested because the duration, the risk seemed less. But in reality, everybody was kind of noticing it. So as the duration of the lockup got shortened, everybody jumped on. And everybody jumps on, there is no arbitrage to be made because, the spread closes. So as this was getting marketed, as this was starting, as a lot more people were de-risking it and it fit into their investment like risk profile, and as a lot more people were like, putting on additional trades because they made money once and they thought they could just roll it again, such as like with 3 arrows, or they did the trade once and actually made the money, and then they did it again with like way more comfortable leverage. You can imagine like this was a setup for what caused the Widowmaker trade. It's because even normal participants were starting to do this. It wasn't just 3 arrows. It was like normal hedge funds. It was crypto hedge funds, which didn't really exist. But even like traditional funds, I've heard, were starting to do this. That just saw a trade that seemed somewhat safe.
That was a really good summary. I've got a couple of questions because you started to allude to BlockFi, and there's also a dynamic here, even in between Grayscale and Genesis. That Genesis was the sister company of GBTC of Grayscale, and there was a lending sort of circular loop that doesn't look great with the benefit of hindsight that was going on there. But before we get there, can you walk us through like what was the impact on price here? Like we all sort of remember around this time that the trade was taking off. This was late 2020, early 2021 timeframe, and obviously there was a massive boom in both the price of Bitcoin and then really ETH. ETH just took off like a rocket at one point after Bitcoin. And like how much of this because on the ETHE, which is the Ethereum version of the GBTC trust, you kind of mentioned they did this thing where instead of a 12-month lockup, it's a 6-month lockup, which attracts a lot more investors. So how much of the price action that we saw for Bitcoin and ETH during this time period can be attributed to folks running this trade?
A lot of it. I think, when ETH went from, I think a lot of people were wondering, why did ETH go from 300 to 4,000? And then 6 months later, it repumped because of that mechanism. A lot of it was spot buying. That was just, if anybody in like hedge fund world, when they see like ETH moving, you typically know like, you always talk about, who's the buyer? It's a sailor, or is it like this new participant? Like we don't know, but usually you can figure out like who's actually buying at that time, because it's just how OTC markets work. You just see where people are buying, spot and stuff like that. And this was just one-sided buy, right? Because people had to buy the ETH, whether it was customer depositors all the way to just like having to like source that income, because deposit you get 5% yield ETH crypto on crypto. A lot of that was attributed to this trade, and it's also why it crashed so hard, and also why the hole was so big, because they were just eating up the spot market for a lot of these products, because again you had to source that crypto borrow, even though you had ETH, US dollar collateral, because you borrowed it and you redeposit it, and that doesn't come back, right? That's why the outflows was like such a big discussion, because once it's in the trust, it's locked there. So that's kind of like the issue. The thing is, like, people were giving money to the BlockFi types, or these Genesis types, because they like the yield. They like the crypto on crypto yield, or US dollar yields that you get for facilitating this trade. And if you ever remember, like this was a time when there was 0% interest rates. Like getting any yield that was like plus 5% just by storing it at some like on non-FDIC covered account, because you're like, what is that? Like some acronyms. That's most depositors would think. Yeah, they'll be like, this is crazy yield. Like, why am I getting like 5 to 10% APRs? Where did this yield come from? Who cares? Let's just deposit them in there. And the marketing obviously was pretty good. And that's where I guess a lot of the market movements happened. A lot of people just didn't see this, obviously, because they didn't see like it's the upper echelons of the finance world, like kind of controlling the trades. But that obviously had a big effect on the entire structure of the market. And I can email some folks per my post, like, yo, this isn't looking good, guys. This is this sounds like everybody's in this trade, and everybody is going to have a hole, because once that leverage turns into a negative, like I said, like 12x negative, based on what they saw as a riskless trade, is it's going to affect not just one participant, but the big guys. And then once the big guys have holes, then all of their clients have holes, and it was just like ripple effects of just max pain. And who cares, right? Who cares about my warning of what was going to happen.
Hey everyone, this episode is brought to you by Mantra Chain, a security-first, compliance-focused L1 blockchain that paves the way for traditional financial institutions to onboard into Web3. Now, I've talked about Larry Fink on this podcast a bunch. You guys have heard the clips. You've seen him on CNBC. He's talking about his Bitcoin ETF first, then his ETH ETF, And then he loves tokenization. And what that means is he's looking at the trillions of dollars of real world assets out there, and he wants to digitize them and bring them on chain. And to do that, we need a compliant L1 that supports that, and that's exactly what Mantra is. So they're positioned as the blockchain for tokenized RWAs and regulated digital assets. They offer high performance, scalable architecture, and they support both permissionless and regulated compliant applications, which is a pretty cool feature. They're built on the Cosmos SDK, so they've got IBC interop, and they leverage CosmWasm for smart contracts, and they've got a whole bunch of cool features like Guard Mobile, passportable DIDs, KYC and AML compliance, and the Mantra token surface. So this is relevant for devs. It's relevant for investors. Definitely go check it out. Testnet Phase 2 is launching soon, and that'll unlock a whole bunch of new opportunities and dApps. So click the link at the bottom of this episode. Again, I get no credit if you don't click the link, so that way Mantra will know that I sent you. So click the link at the bottom of this episode and go check them out for yourself. One other dynamic that I think is important for listeners to understand is the lending market structure that existed back in 2021. So a lot of the leverage that was flowing into the system were from these lending desks. So, like Genesis was a lending desk, but also BlockFi was creating a lot of leverage in the system. And the way that they were doing this was, again, the business model of BlockFi is they were almost like a customer-facing banking type operation. They wouldn't have described it like that, but basically you take your Bitcoin, you deposit, and BlockFi would pay you out yield. Imagine like a savings account in a bank, and then they have to find a way to farm that Bitcoin out on the other side into theoretically safe lending and yield opportunities. So basically, what BlockFi, the challenge of BlockFi and Celsius and like whoever else, these like Genesis, these lending operations, where eventually the demand for borrow started to dry up and the opportunities to source yield safely went away. But that was like an additional dynamic for like where the leverage was being sourced from. The other thing was Genesis was a sister company of Grayscale. And I think one of the circular loops that started to kick in there is that Genesis would start to allow their loans to be collateralized with GBTC. So there was a dynamic where you could borrow money from, say, BlockFi. Actually, Genesis eventually started doing cash loans as well. You would borrow money from BlockFi, lever up into GBTC, take your shares of GBTC, that you get from Grayscale, deposit with Genesis, get another loan, and then loop that back into Grayscale and just keep doing that trade, right? So that was another dynamic for why this all got pretty out of control.
Yeah, I forgot to mention that, the way that you've achieved this like under collateralized borrow, quote unquote, was that you gave the right of the shares back to the company as the collateral. So the holding codes would try to be like obviously more. This is how you justify under collateralized borrow, so they would hold the shares until the end of the loan, and you get paid out. But then the hedge fund would just be at or like the funds or whatever would be in a negative with this operation. So that was kind of like kind of the issue, and that's why everybody got hurt that was holding these assets, and especially when people couldn't repay because they're in such a big hole. So that was one of the structures that existed. And after this trade, like yield really did dry up, and credit was hard to find as all these shops kind of disappeared.
You can see how the virtuous flywheel would kick in on the way up. So the price of Bitcoin is continuing to go up. There's a bunch of more money coming into the space. There are a bunch of lending shops which are happy to offer this leverage. They need to find yield opportunities as well. So there's this, and all of that is kind of getting recycled back into GBTC, which is causing the underlying price of Bitcoin and ETH on the ETH side to go up. So you can kind of see this, like people are levering up into this trade, and it's actually creating this reflexive feedback loop. What were some of the early warning signs from your standpoint of being in that trade? And walk us through the series of events where things started to break down and it started to go in the other direction.
The first one was that the premium was decreasing. We were looking historically at GBTC, like, hey, when we were entering the trade, we were like, hey, this looks still like there is still a premium, obviously, but it's like obviously teetering. And historically, it always teetered like double digits before it went back to triple digits and stuff like that. So the premium itself was looking like somewhat unproven, but like I said before this, it never went negative ever in history at GBTC or ETH. At one point, ETH was like like 500% premium. It's just like, it was crazy. Like why would it be so much higher? There had to be like something a scalp from that. Was the thinking. We actually went to some exotic like option desks to like write this like pseudo exotic put on the premium itself, just to hedge in case this would have happened. And they wouldn't underwrite it. Went to like 3 desks. They're like, yeah, this is too weird. We're not going to do this. And I'm like, okay, I guess we'll do a little naked, because like I said, a lot of people have done this trade before, and it seemed to have made them cash. And that was some early warning signs that kind of gave a hint of like that. And I guess it was also like, I guess there was a little confusion about the management fees of the fund, because it was exorbitantly high. Like it was like percentages, I guess, on the underlying asset just from holding it. And just why it was such a cash cow for the parent co, Grayscale, because it's if you had billions in assets and you're getting like a percent fee on it, extrapolated multiple years out, DCF it back, like it's a great business, and it's generating like great fees for the company. So that was those were like the soft warning signs, but the premium was always high, and the trade was like somewhat known. It eventually became very known across the board, and it was also just like a lot of these lending shops started to package it as a trade, and they're selling a trade. It's like you're talking to the S&T guy, sales and trading guy, just like telling you about a trade, and then you're trying to buy it. Once that started getting popular, there was no money to be made at the very end. So there's a lot of people that thought they could make some easy cash, as is with every bubble, that turned into a situation where nobody makes any money, because there's no such thing as easy money. I guess that was kind of like the early warning signs of like why it could have gone south. And it was also just like I guess the comfort of people putting so much leverage on this trade. That's defining the confidence. We, like I said, we were one of the lowest leverage participants, and we even verified with like people like what is the average? The average was like 5 to 20. We were definitely under that range because we were somewhat concerned, and thought about doing it flat. But then the trade wouldn't have been worth it, because there's a lot of operating costs and interest rates and stuff like that. The interest component, as per my tweet, like is actually the most concerning for us, because the interest piles up as the underlying asset increases in value, because you have 3x leverage, but the underlying asset at this time went from $300 to like 2,000, and then it dripped back down. Thank God. You're paying 5x times 3x interest over like a 6-month period. So that really compounds and eats into your equity. But even that's like after the discount happened, we were like definitely concerned.
What mechanically led to the decrease in premium? Like what was it actually mechanically that made it go from a premium to a discount?
It was really like how popular the trade got, frankly. Like a lot of people started doing it. And it was also, like I said, that duration of lock being reduced. So that's what really made people like trying to jump in and get comfortable with it. And that was kind of like the initial design. So once that happened, like it's pretty straightforward what happens when it goes from a premium to discount. Now, why it didn't go to like a significant discount at the very end? Because for a while it stayed like a slight discount, which is why we kind of got lucky getting out of the trade so easily, like at single digit discounts, because it is mean regression. Like it should go down to 40% if it's been a premium for so long. And that was because a lot of people thought it would come back. A lot of people stayed in the trade. And we got out pretty easily, even though we were like 10% of ETH for the size that we were doing. 10% of liquid that was kind of being originated at that period, not the entire supply. Sorry. And we still could get out quite easily, because a lot of people are like, hey, it's going to come back. And they're putting on the discount will come back to a premium trade pretty early on. So that was like, that was surprising, frankly. Like even some of our backers were like, why don't you just stay in the trade? And I'm like, are you guys crazy? Like this is like negative equity right now. Like we should definitely get out and cut our losses. And some people stayed on. And then to that example, like, in the very beginning, I said like 12x like money. It's also negative 12x equity, because it would be it's a negative symbol right in front. So people, and this is why the hole existed, like because people just stayed in and just let it roll, and they just thought it would come back, and they were just asking money from friends to pay the interest rates. interest fees that came across it. So,
hey everyone, we'll be back to the program in just a moment. But before we return, wanted to let you know about DAS London. DAS London is the largest institutionally focused conference in crypto hosted by Blockworks. But I wanted to give you an update because we are now 10 times oversubscribed for this conference. So the bad news is we have actually got to lower, as much as I love you guys, the listeners, we've got to lower our discount rate to margin 10. That's going to get you 10% off. I would highly recommend that you do that soon because you might have noticed ticket prices have gone up 200 pounds and they're only going up from here. And I actually can't guarantee that we're going to have this discount rate forever. Since we last talked, we've had a whole bunch of new great speakers sign up for the conference. We've got Brad Garlinghouse as a keynote. We've got Pascal Gauthier as a keynote. We've got new speakers signed on from Goldman Sachs, from Franklin Templeton, from some of the largest family offices and allocators based out of Europe. So Theta Capital Management, L1 Digital. And actually on day one of the conference, we're going to be having an investor day, which is a Chatham House rules hosted by some of the largest investors in crypto. Then the other thing that happened is we've got our VIP tickets that just went live. There are only 60. But we've actually had a bunch of them that just sold out even in one day. So if you want to be a VIP at the conference, make sure you get your ticket. And again, use code MARGIN10 to hang out with me and Mark March 18th to the 20th in sunny London town. Cheers. How easy was it? Can you describe the process of unwinding that trade, maybe from your perspective as someone who had a sizable amount of the ETH supply? But there were definitely, would it have ever been possible for someone like that, like BlockFi scale, to get out of this trade? I don't know how much they had in it, but how easy was it to unwind?
Yeah, I guess it's tough to know because we were looking at daily liquidity and try to be like at least like 20-30% of the daily liquidity for selling in order for the sales that we had, because it was on leverage, and it would be really tough, frankly, to like get out of that position over that period of time. It's easy if there's a premium and you could like whatever buffer because it's all free money. But if you're losing money, then each time you cross the spread go down, like it's tough. The volumes, like I said, it was number one and number two on OTC markets at all times. Like GBTC was number one, and then some weird pharma company number three. It's like, it was always the most popular traded asset on these markets. So the volume was pretty high and traded a lot higher than a lot of other products because it was, BTC was hot at that time, so a lot of people were buying. Retail was still buying it at that period of time. So it was a market to like get out into. But eventually that kind of crashed because the discount went down to obviously 40-ish%, 50%.
Just to put a bow around it, because maybe some listeners who are listening to this are thinking, well, why was this such a problematic trade once the discount flipped? Like, couldn't you just, you kind of like lose what you put in? But I think that just the math on this is the leverage part component of this. Yeah. So if you had, let's say, $100 million worth of equity, actual capital that you put into this trade, but you were levered up 10x, you had $1 billion worth of exposure. So if that premium that you were going to extract flips into a discount, you could lose many multiples of what you had originally put in, right? Is the way that the math works. And that's what ultimately ended up happening to a lot of these big funds like Three Arrows Capital. And then this recursive feedback loop that fueled this trade, that's what ultimately ended up causing so many problems in the industry, right? Because everyone was lending money to one another. And when you start to have massive holes like Three Arrows Capital, then all of a sudden, boom, there's a big hole in BlockFi. And then there's a run on BlockFi, then all these other people that are sourcing, it's just everyone was related to one another, which just made it such an incestuous pit and so difficult to like piece apart, basically.
And that was kind of the issue. It's like you were giving money to people because they had a pretty good Twitter profile. Like, that's so bad. Oh yeah, like this guy had like this guy had a lot of followers. It's sick that I got like 5K followers from my tweet, right? Like, give me money. No, that's not how it works. You should be able to look through their balance sheet. And if you do under collateralized loan, like giving money and getting yield back, like you should pierce through like the underlying asset. This has been an issue since like the olden days of the bill of ladings and double financing against like a commodity ship. It's the first thing you do is like, am I the only customer, and how many other people are exposed? And this is kind of the issue with finance, and why I guess DeFi comes back to being kind of cool. It's like, you can't look at everything at once. There's no like hidden structures. Like, exactly what's open and where the books are. You can open things up and actually see through it. And people were giving money to Three Arrows thinking, yeah, they're great. Like, did you see his last tweet? It was hilarious. And then that was a diligence process. It's like, yeah, let's give money to these guys. They're promising this much yield. Crazy.
Yeah, I mean, I feel like for folks who might be listening and thinking you're exaggerating, I just want to underline the point that you're not. And there was, diligence processes that got run literally on the order of, this person seems like they have a lot of followers, or, oh, I trust this CEO or this fund manager. So and a lot of this lending was under collateralized as well. I think at BlockFi it was collateralized, but it was collateralized with GBTC.
The own shares, yeah.
Right.
Yeah, exactly. But then the other people who, I mean, I guess the trickles back down, like, BlockFi, and then the funds that were doing it, and the funds that promised to get extra yield for, whether it's BTC miners all the way to, other lending desks that were like, hey, these guys somehow have yield. And they went global because crypto is a global industry. So it's harder to like look through different things versus just like being fully US denominated. A lot of this issues kind of came not just domestically, but also abroad, because you have all these lending desks like Babel and stuff like that. And kind of just spread everywhere. And you really don't know how big the effect was. So over the years, you were seeing like across 2 years, like, yeah, we're blowed up. Like, we didn't tell you guys for a while because we're just hoping that it'd get recovered somehow. But I guess it didn't happen. And this didn't bring FTX down directly. That was obviously them lending against their own like underlying like tokens and assets. But this is what restarted the whole. And FTX is another story that I can talk about, which it was interesting diligence I did for them with regarding to like how it first started with a hole. There was a time where they didn't have a hole. But this is what restarted it because it was just so popular of a trade.
It's just kind of a classic duration risk story, actually. In a very,
yep.
A lot of people are gonna poke at me for this, but at a high level, it's kind of similar actually to what happened with banks during last March, which is this large portfolio of collateral in the form of long duration, like 10-year, 30-year securities. It went down far more than anyone thought it possibly could, and it put a lot of these banks in. It's not a credit risk situation. Ultimately, those treasuries are going to be money good, but if you needed to withdraw all at the same time, it would be massively problematic. And that's kind of what happened with Grayscale as well. It's like, now I'm pretty sure now that we've got the the ETFs, the discount has basically closed. Right? I don't know what the discount is today, but I saw it's basically nothing anymore. So if you'd been able to stick it out, then you could have lasted, but that isn't what happened. And
yeah, it took too many years, and you would have paid interest the entire time because it was on leverage.
Right.
So I was just going to say, like, it's also like because of these like hidden like shadow banking esque structures. Like another thing that would have been nice, like if it was transparent enough, you could have made the debt tradable, which would have been cool to see. Like, hey, what's the repayment? Which is what you say with FTX shares, or FTX exchange market, like what is this to the dollar? Does it reach back to premium? But like, if you have that kind of price discovery and like you can trade in and out of that debt, that could have solved it too, not just the original issue. Just kind of like, San Francisco real estate, like mortgages, like it trades at a discount now, stuff like that. But that does help like alleviate like the original risk as it trades from premium to discounts, and somebody is willing to take slight losses over the period of time. So there's other ways to make sure that doesn't blow up, but the loss still would have been there. But because it did blow up, that's where we are today. And it's also why I'm like somewhat excited about the market as it is, because there aren't any like, from my understanding, that big of like holes. People talk about on-chain stuff, but in terms of like TradFi, which is really the cause of the bust, like there isn't. I mean, because there is literally no credit. Like it's hard to even get loans outside of just like some platforms. But we'll talk about some other reapplication things on chain. But like it does feel like a fresh start, which to me is enough to catalyze, I guess, a market recovery and see, I guess, where Bitcoin should have been. But I mean, we also printed like multiple X's of our money supply since 2020. So I don't know if the price actually went up or just more money in the supply. BTC is actually the same price. So
yeah, David, maybe is starting to wind down here. Do you think that, I guess you sort of just answered this last question I was going to ask you, which is, when you look out into the market today, is there any cause for concern? And I feel like what I heard you just say is, not a lot of the same type of leverage and credit is being extended and there's no like weird products like GBTC out there, or kind of like hidden, the net effect is that there's not very much hidden leverage being injected via TradFi. But you did mention on chain there being potential concern. Like,
Yeah.
can you walk us through what that is? Like, and are we at risk of repeating the same thing, or what do you think?
I think what's happening on chain, I mean, in DeFi, because I guess I'm building in that space, and I can mention that very briefly at the end. But you're seeing rates increasing. I guess the introduction of staking has introduced not a risk-free rate, but like a base rate of yield that is from a base economic activity. T-bills for US dollars, but ETH denominated as staking. So it's kind of like when in raising rate environments, high yield bonds win versus like equities get trashed and then T-bills suck. So it's kind of milk and ass kind of like era of like high yield, which is why everybody is in private credit and TradFi. I like to say like that's kind of like the new like hot industry because it's the most macro friendly. So I think you're seeing that with like liquid restaking tokens, like kind of people assuming it's a risk-free rate when there is liquidity issues with the underlying assets. So people are just like assuming that it's effectively safe collateral. I think that's kind of like the same kind of ideas. Like when you think something's safe, but it really isn't, and it's mispricing a risk, whether it's duration or liquidity, or just assuming that it's equivalent. But it's not that much of a risk because it still is backed by, again, the ETH itself. So in the ETH ecosystem, at least, it's not really a big concern. It's like the largest concern I've heard, but frankly, the underlying asset is still there. It's still over collateralized lending. It's still like, it's not under collateralized. There's no like weird like bar strategy that's over levered. There's no Terra where mechanism just goes down, which was a far worse trade than GBTC in my opinion, because that just went straight to zero. It's not like FTX does bankruptcy. You get like now 80 cents to the dollar today. It's like that's true zero, and that was actually my worst loss, way more than GBTC. So those mechanisms are obviously being diligent, and I think the ecosystem is just maturing. Like this was like when DeFi just kind of came out, and but now that we all have a little more sensitive ear in terms of like what exactly is risk, what exactly is risky. Again, the sirens are a little closer to pull. Yeah, I mean, in the market today, I think there's definitely more. I haven't seen like a over discussed, over converse trade right now that comes to where everybody thinks it's safe. I'm kind of like a specimen, but I'm frankly I'm very, very excited about BTC. I'm not going to say it's financial advice, but it's definitely like at a time where it's starting to become truly the institutions are coming. Like that meme is finally here. So that's definitely exciting to me. I think it's starting to like rebrand and kind of be an asset that is starting to be accepted as like a global like standard because the US has finally accepted it as an ETF. That's a huge branding event, and over next year, I'm not going to see some artificial priced like action like forcing to go up, and it truly feels organic. Which the only thing that like and really the next steps is just make sure the last chapters are closed. So you had all these warning like concerns, like hey, you had this grayscale ETF like outflows, like that was everybody's concern. Everybody was talking about this even before like people like all those charts existed. Now this was everybody's talking about. There can be so much sell volume, but we're over the hump. The Binance thing, there might be a DOJ thing, and it's already being settled. It's $4 billion, which is not that bad. That's settled, and then FTX estate that's settled. Maybe Mt. Gox, but it's not that much compared to Grayscale. So all those chapters are done. It just feels like a fresh start, and that's why I'm quite excited because I guess the bad demons are gone, and going forward, it really feels like just organic interest. And it's a new industry, I guess. It might be linear growth at this point instead of just something super like super cycle, like as they say, where it just like exponentially grows up. It might feel a little more linear, which is tough because everybody just wants to short every time it's linear. But it's remnant of a bear market. So that's my thinking going forward. And I guess just looking at like on-chain stuff too, it's definitely like a lot more innovations that are coming out. That gets me excited, at least for what we can do for, I guess, crypto.
The linear point is a really interesting one. It's tough because Su Zhu, who's the founder of Three Arrows Capital, famously called for a super cycle, and this thing at the end it obviously wasn't. And people have been saying that for a long time. But I do think one of the things that I'm starting to come to terms with is I think there are lots of structural reasons why this industry is going to continue to be cyclical. Even in the TradFi world, there are business cycles. They don't really exist anymore because the Fed is seemingly messing with them. But historically there are these business cycles, and I still see a lot of structural reasons for why it should be like that. But I do think the net new incremental dollar that's coming into Bitcoin is now a passive structural dollar as opposed to a retail dollar or someone that's trying to front run retail. And so basically the net effect of that is like they're mean reverters, right? So instead of chasing on average, they're going to try to mean revert and sell if it's gone up too much or buy if it's gone down too much. And whereas retail doesn't do that, they let it go absolutely to zero or all the way to the moon. And I do think we should be prepared for something that looks more like a random walk, or like not a random walk, but a slow walk up, slow, more linear walk instead of these exponential boom busts. But I do you agree with that thesis overall?
Yeah, and that's kind of like why I guess I mean the sentiment markets, like obviously rates are not zero anymore for ETH or USD, and that's kind of why it might feel like a little more linear, because it is a time when we're kind of discovering like the risk curve or the rate curve of crypto, of like things that are happening domestically within crypto itself and generating its own yield, whether it's staking all the way to these other assets. So that's what gets me interested. It's like, how do we encourage this linear growth in the market today? You're seeing products like Pendle and stuff like that come out, including my own company, MetaStreet, which focuses on like how do you create like higher yield with higher risk. I'm not saying it's riskless. I'm saying it is higher risk, but it's also higher yields. And that is actually like I said, in terms of macro, is what seems the most interesting. Is like how do you achieve like a productive yields in a sense. So that's been my thesis, at least.
David, maybe in our closing minutes here, could you just say, first of all, you put the genesis of this conversation was this great thread that you put out. So we'll link that in the show notes, and people should have to go follow you on Twitter. But could you just say a couple words about what you're building, and then we can wrap up?
Absolutely. For my Twitter, that was my first story out of my many stories that I've lost a lot of money on over the years, whether it was MEV all the way to FTTC round, which was full of holes, and I'll talk about that in another thread. Terra, and then also like the origin of my company. It's like it all kind of starts with like big mistake, and then you kind of learn from it, and you kind of like make interesting things out of it. For MetaStreet, we're looking for, I guess, illiquid assets on chain, and that's very common. If you think about like most of finance, it's not actually money markets, which is what DeFi is obsessed with. It's actually caps for the markets, where you have illiquid assets and you can turn it into great yield. Houses, equipment, college tuition, like these things are great yield. They are the largest assets in the world, like U.S. real estate, and we're trying to like bring a lot of those concepts of like creating these liquidity products against these assets. I think a lot of people are like really focused on stake yield, which is great, ETH and ETH yield, that comes from securing the network. But then you have all these other like illiquid assets on chain, whether it's like gaming assets all the way to like CryptoPunks, for example, that yields way higher multiples on this risk-free rate. So for CryptoPunks, like the market clearing on like let's say NFTs, it's like about 23% APR ETH on ETH, which seems a little like crazy, but because and that's also why like illiquid assets in TradFi, like they're almost higher than the treasury yields. Why? Because it's risk, and it's just a question of like how do you structure that correctly, and create, I guess, like this product with just liquid credit tokens, liquid staking tokens, to produce that yield. That's what we're really focused on building. Is like how do we create like a favorite DeFi words, oracleless, permissionless, and governance-less protocol that like can extract those yields, bring it to the public, and have people participate in this ecosystem without having to actually care about the underlying asset. When I was at DBD, like it didn't matter what the collateral is, as long as it's produced yield, that's called yield. So it went from all the way from like I used to work in like art lending all the way to like Regal, which is real estate, gaming, lodging, leisure. So we looked at like even timeshares to trailer parks to even normal houses, like all that produces yield. And that's kind of the alchemy of finance, is that you can find interesting ways to have both parties benefit. So that's kind of what we've been focusing on. It's like, how do you have this like a protocol that can produce interesting yields from any asset, starting with CryptoPunks, because I think it's the most consensus NFT, and it's also dealing with the most liquidity, with rather high APRs.
Well, guys, definitely, go check out what David is building, and not financial advice to your own research, but sounds super interesting. And dude, thank you so much for coming on the show. This was a great episode. I kind of knew at the high level some of this trade, but I didn't know a lot of these details, and this was awesome. I think it's going to be super valuable for the listeners. So thanks, man. We'll have to do this again sometime soon.
For sure. Thanks for having me on. Maybe after another thread blows up,
Let's do it. Let's do it. All right. Cheers.